Hello ladies and gentlemen, thank you for tuning in to Ascending Abundance YouTube channel. My name is Pavel Sverdlin. I am a CFA, Chartered Financial Analyst, Certified Public Accountant, but I'm not an advisor. So please do your own research. This is not advice, just my own observations on how to make money with your own capital through equities, crypto, real estate, business, anything that comes. This video is dedicated to fact-checking some of the claims and analysis done by Raoul Pal. He's all over YouTube. He's done phenomenal research, added a ton of value to my own thinking, but he shares claims like there is a 97% correlation between stock performance, overall stock market, and the amount of money in the economy. So I wanted to double check and see this for myself and maybe reach some conclusions on my own. So I've put up Federal Reserve data on their balance sheet, so you can see that. That little blip is the CBV collapse in early 2023 in the spring. And I also pulled up the chart and the data for the monetary supply in the economy. This is M2, also available from the Fed. And I also pulled the data on S&P 500 and NASDAQ from Yahoo. Very straightforward. So what am I saying? What I'm seeing in nominal terms is that the money supply is obviously going fairly smoothly until we hit COVID. And then the stock market is obviously rising. This is from 1999. The axis here is in trillions. That's the monetary supply. Here is the indices levels. So we can clearly see S&P 500 kind of lags the NASDAQ levels. But one being above the others doesn't quite tell us the entire story. Same idea here. So there's clearly a correlation. The Federal Reserve balance sheet is growing, NASDAQ is growing, S&P 500 is growing. Which one is growing faster is hard to say. And my question became, can we invest in the broad market indices and beat the monetary debasement? And which of the indices should we pick up overall going forward? So here is a normalized view in the percentage terms showing in the growth in the money supply, growth is NASDAQ, and growth in S&P 500. What sort of dawned on me that the money supply, as Raoul Pal explains it, the money supply is basically the interest on the debt. So let's say government debt is 100% of GDP, so the interest on that government debt is going to be, unless the rates are low, is going to be so high that it's probably going to be higher than the GDP growth. So almost no matter how much your economy grows, and S&P 500 is sort of the proxy for how the economy develops, your government interest and the money that they create and print is going to feed into the overall supply and overshadow the growth of the GDP, unless GDP starts skyrocketing, which I don't see happening, but it's possible. At the same time, we have personal debts, we have corporate debts, commercial debts, states level, all kinds of debts, and the interest on those also is accumulating and accruing, and the money needs to be created in order to pay that interest and roll it over in the future debts. So the interest is driving all of this money supply to be at the levels higher than your economy could sustain or show over the longer periods of time. So S&P 500 in and of itself is barely kind of trying to catch up but cannot. And that's why maybe in your personal lives you're seeing that no matter how hard you work, it used to be that there was one breadwinner in the household, now two people work, sometimes their kids also work, and we somehow don't feel like we can afford the luxuries and the free lifestyles that we desire to be. That's a whole separate conversation. The monetary debasement that is depicted by this money supply is not the same as rate of inflation, because goods and services are getting cheaper because we are digitizing, we're trying to cut costs, we're coming up with new ways of making things better for everybody, and we do enjoy phenomenal luxuries in our lives that couldn't be enjoyed by generations before us. Again, that's a whole separate story in the discussion, but nevertheless the growth in the economy doesn't seem to be matching, and one way of getting out of it is to invest in NASDAQ and hopefully keep up with the rate of inflation, because otherwise, not rate of monetary debasement, hopefully keep up with this monetary debasement so that at least your purchasing power is not diminished. If we look at the Fed balance sheet, kind of a similar story, but also very volatile. It just kind of jumps up in these huge cycles and then it goes down. And we can see that there is a mismatch here. The balance sheet is declining, just like it's been here. The stocks keeps going up, and it's not like it's going to necessarily reverse, because again, here it kept on kind of going up while the stocks were continuing to rise. And it's only at some point that my mouse is malfunctioning. It's only at some point that we saw a final kind of monetary policy change, and there was a change in the direction of the Fed, but the markets did not fall. It just continued to rise. So we don't know the correlation is perfect. And then when Raul Paul says it is, I'm kind of curious to see what it is. And my mouse keeps on malfunctioning, so I would have to apologize for this small delay. Come on, there you go. So if we go down to the percentage changes, just like for the money supply, I looked at both. So I looked at the percentage change in money supply, at the Fed assets, kind of normalized it to the zero, and then as I compare all three of them, or actually all four of them, so NASDAQ, S&P 500, as well as the money supply, here you could tell that the money supply keeps on going up. So I took 2009 as a starting point. The previous charts were from 1999. Going forward, this is from 2009. And you can tell that from 2009, post that big drop from this great recession that we've experienced in 2008, 2009, that's a little better representation of the stock market performance. Between 1999, 2000, and 2008, there was this boom and bust, and overall stock market done nothing. So just sort of eliminated as an empty decade and focused on the last, 14 years worth of data. So what you could see here is that the money supply actually does get a little bit lower than the stocks. S&P 500 does beat the monetary debasement over the last 14 years. It doesn't quite beat the Fed balance sheet, but that's less important. What's important is that by investing in equities over the last 14 years, we would have beaten this monetary debasement. NASDAQ clearly overshadows S&P 500 and makes our money go way more further than the monetary debasement could take that purchasing power away from us. Whether that's going to continue or not, I have no idea, but I found this very enlightening and quite informative. And I believe that the stocks or the companies in the technology sector are taking economic value out of the stocks that are and companies that are not in the technology sector. Everything is becoming more digitized, everything is automated, robotics, AI, chips, everything's automated, simplified, digitized. So the value from the typical but the capital-based, capital-intensive, kind of on-the-ground, brick-and-mortar type of assets that are required to run regular business, it's sort of slowly being adjusted and converted and goes towards the companies that do technology. They could scale faster, they can make their per unit production way cheaper, they evolve also faster than the typical brick and mortar companies. So I believe we've seen this across the board, starting with Amazon. Anywhere Amazon goes, that business sort of dies, and Amazon just takes that economic power and grows and grows and grows. So technology looks like it's the way to go, at least based on the last 14 years that I'm seeing. And technology did get a huge boost previously, and it doesn't seem like it's stopping anytime soon. So back to the question then on correlations. So Raoul Paul was right. There is a correlation between M2 supply and S&P 500, 97%. M2 money supply and NASDAQ, 97%. Between NASDAQ and S&P 500, 99% correlation. Federal assets, Federal Reserve assets and M2, 98% correlation. Now, Federal assets and NASDAQ is actually 92 and 93. Very high still. I mean, 92, 93 correlation is phenomenal. And correlation doesn't mean it's fully predicting it. It just says when Federal Reserve assets are growing, or when M2 is growing, then stocks are also growing. It doesn't show you the magnitude of the growth, but it shows directionally they seem to be moving in the same direction. So that's a huge correlation coefficient, and I would say money supply is a somewhat better predictor than the Federal Reserve assets. So the balance sheet of the Fed, as much as the money supply is tied to it, and there's a big correlation between the two, it's a little less predictive, and it jumps way more sporadically than depending on what the Fed does. So pay attention to the money supply. So then I looked at M2, and I'll make this picture a little larger. So M2, this little table, down here, I just manually sort of calculated over the years how much money supply was added to the economy. So if you can see it, our purchasing power, the debasement of the currency, is happening at a rate of 7, 10, 5, again 10, 4 and 4, again 10, 8, 6, 6, 6, down to 4, and like it seems to be going up in these waves, and then it went to 26 and 11%. So only in this 2 years of pandemic and COVID, we grew the money supply by 37%. Obviously inflation picked up, obviously stock market picked up, but now look at 2022, the money supply has gone down. In 2023, the money supply is probably going to go down again. So based on this, let me just make sure that I am calculating this. Yeah, this is 2022. In 2023, like 6 months or even 5 months of 2023, you can already see that the number had gone down by another 2%, right? So the monetary stimulus, this printing of money, had kind of slowed down. So inevitably, it should have led to a decline in the stock market, but we have such a momentum that it kind of kept on creeping up. It was such a down year in 2022 that in 23, I guess it sort of bounced back. The GDP growth that we're seeing is 2.4%, 2.3%. I believe it's below the inflation rate, so it should have been in real terms negative. I don't think the economy is growing, but nevertheless, back to the correlations. So the monetary supply alone over the last 22, 23 years had debased the currency by 163%. I don't know if you've been in the workforce for so long. I don't think I've started in 2000, I started a bit later. But you could see how much more money was created in the economy. Dollars are now buying less and less, and if it wasn't for the digitization and making things cheaper, the inflation would have eaten away a lot of your money. Imagine retiring in 2000. Just 20 years into your retirement, which is reputable, your savings or your pension or whatever is now buying like a fraction of what it used to be. So nevertheless, go back. Correlations are great, but I wanted to see if there is a direct relationship. So not only they grow in the same time, but how much do they grow? So for that, I built a simple Excel ANOVA table. I don't have to explain necessarily what it is, but adjusted R squares is what is kind of mathematically showing you the relationship between the variables. So very strong between S&P 500 and the M2 supply is 85%, M2 supply and so Fed assets 85%, M2 supply 94%. So again, not quite the 97 that we see here and the 92. It's smaller, so the magnitude of the growth is not as correlated as the direction of the growth, but it's still so much correlated. So M2, the money supply, is what to watch for. And so long as it's declining, I wouldn't bet that the stocks or the economy are going to do well. The money in the system is shrinking. If the money starts increasing again, which I do expect to happen within the next year, then we should see some positive returns on crypto, on stocks, on all kinds of other assets. So thank you so much for watching, and until the next time.